Ladies and gentlemen, please take your seats and welcome NAR Public and Federal Issues Liaison, Nate Johnson.
All right, good afternoon, everyone. We are on the home stretch. Stick with us. We are just under an hour away from being wrapped up with this amazing program for today. And I would now like to introduce our final presentations of the day. The economic and social benefits of housing market and homeownership are immense, as we know, and it's been well documented. Dr. Lawrence Yoon and David Bank will discuss new research that bolsters these findings and shows the significance for homeownership and improving financial security and net worth. They will also discuss the importance of tax incentives that help make homeownership more affordable for many Americans. Lawrence is well known to all of us in the community, of course. He serves as the chief economist and senior vice president of research for the National Association of Realtors. Lawrence oversees and is responsible for a wide range of research activity for the association, including NAR's existing home sales statistics, affordability index, and home buyer and seller profile report. He regularly provides commentary on the real estate market trends for its 1.3 million realtors. He appears regularly on financial news outlets, is a frequent speaker at real estate conferences throughout the United States, and has testified before Congress. Lawrence has appeared as a guest on C-SPAN's Washington Journal and is a regular guest columnist on the Forbes website and The Hill. David Bank is the senior vice president of the Rosen Consulting Group. He is responsible for managing RCG's strategic consulting projects, supervises the research team, and directs housing policy research and consulting engagements. He is the team lead for multifamily and single-family housing market research and co-authored a series of white papers on homeownership in America, written in collaboration with Kenneth T. Rosen and published by UC Berkeley Fisher Center for Real and Urban Economics. Prior to joining the Real Rosen Group, David served as an economist at the U.S. Department of Housing and Urban Development in the Office of Policy Development and Research, where he was responsible for analyzing regional economic and housing market conditions. Please help me give a warm welcome to Dr. Lawrence Yoon and David Bank.
Thank you. Excited to be here. I just want to make sure the slides are visible. Okay, wonderful. Thank you very much to NAR for inviting me to speak here. I'm excited to be here and excited to talk a little bit about a new report that we at Rosen Consulting Group have put together, prepared for NAR and the Federal Tax Committee at NAR. We wanted to look at the question of really kind of two things. One, to look at the question of incentives for homeownership in the federal tax system, the federal income tax system. But in order to do that, I think we heard in the previous panel about how really we need to have a story, a narrative around why that is so important. And so, the first thing we really look at in our paper are the economic benefits of homeownership, as well as the broader social and community benefits. And the idea there is to really provide insight into the extent to which this is really important, not just for households as they work to increase access to homeownership and gain the benefits of financial security and wealth building, but also to the economy at large from a more macroeconomic perspective. So that's actually where I want to start. We've heard through the panels earlier in the day about the way homeownership in this country has shifted over the last decade and decade and a half even. Since the recession, we had a huge drop in homeownership, and while things have begun to recover a little bit, really we still have homeownership rates being very weak, and particularly homeownership fell most significantly and remains weakest for three groups of households: middle-income households, minority households, and millennial households. And those are the groups that still today, while they're among the fastest growing groups of households and the biggest potential for homeowners in the future, they're the groups that face the biggest hurdles to homeownership. So in that context, we wanted to think about what the potential economic benefits are. In particular, we wanted to think about things first from a broader macroeconomic perspective, try and kind of bring a new light to what this really means for the economy as a whole. And, as we started looking into the various areas that homeownership impacts the economy, one of the things that we really focus in on is that the overall U.S. economy today is growing at a pace of around 2%, 2.1% in the fourth quarter. That's continued growth. We've had growth throughout this cycle, the past 10 years of growth, but it's growth that's much slower than where the U.S. economy has been historically. Over the long term, we typically expect to have 3% GDP growth every year as the economy expands, and that's really where the potential for our economy should be. And a big part of the reason we believe for the gap in terms of where we are compared to where we could be is that the housing sector is still a decade on, not really reaching its potential, not really operating in a normal way as you would expect during a growth cycle. And that's really looking back over very long-term trends in terms of what a normal level of housing market activity would be. So in particular, we focus on the ways that when you think about bolstering homeownership and bringing the housing market back to a normal level of activity, what that might mean for the economy as a whole, and the ways that that might generate a wide range of benefits, ranging from more new and existing home sales, more home construction, more availability of housing, construction jobs, and overall economic activity. And importantly, when you think about these broader macro benefits, those actually accrue to the economy as a whole. They accrue to both owners and renters, and they're not just limited to those that are able to buy a home, but rather have this bigger economic benefit. So in particular, I want to focus on this one segment of the housing sector that I really want to focus on, and this is the concept of residential investment or residential fixed investment. Now, this concept looks at the portion of the housing sector that captures home building, both single family and multifamily, and also remodeling, renovations, also includes commissions on home transactions. So we really focused in on this as a big factor because for a couple reasons. First of all, when you look over a long-term history, residential investment is one of the areas of the housing market that is still weakest today and really had the least recovery in terms of the role that it should play in our national economy. This chart here looks at the trend over the past 60 years for residential investment relative to the size of our national economy. And historically, the green line here, that shows the historical average of about just over 5% of our national economy and national economic activity being captured by this concept of residential investment. And what you see is that there was a huge drop in that share following the recession, and importantly, it's recovered really very little, and in fact stalled out over the past 2 years and even dropped to the point where, as of the fourth quarter, this is really now representing only 3.1% of our total economy. Now, the difference between 3% and 5% may not sound like a lot, but in the context of an economy that in real terms is $19 trillion, that's a huge difference. So we also looked at this in terms of the level of residential investment. And again, if we look in absolute terms adjusted for inflation, residential investment, home building, and construction has recovered through this cycle, but really stalled in absolute terms as well. It's actually $18 billion lower than it was the end of 2017 now. And there's a lot of factors contributing to this that we're concerned about, but included in those are challenges around affordability, challenges around access to buying homes. But one of the factors that also contributed to that was the shifts in the tax incentives that came about as a result of the tax reform. So before I get more into the tax incentive piece, what we looked at from a very macro perspective is what would it look like if the economy got back to a more normalized level of residential investment in this key sector of the economy. And we did some estimates looking, trying to be conservative, looking at what that was like, what that portion of the economy represented over the last 30 years, and then also looking over the much longer term, 60 years, what we think is actually a better measure of what a normal housing market might look like when we include the time period where we really built housing in this country earlier in that 60-year period. But depending on where we are in those assumptions, the potential for economic activity for the country as a whole, if we could get back to a normalized level of residential investment, is somewhere in the $200 to $400 billion range. And if we think about that transition happening over, say, a period of 4 years, that would account to about 1/4 to 0.5% of national GDP per year. And that's pretty significant in the context of where we are today at 2% versus where the economy has been historically at 3% growth. Of course, there's the additional benefit that as the economic activity were to cycle through the economy, there'd be the potential for significant federal tax revenue to be generated. So, from that first perspective, there's a really big economic story around how homeownership should be contributing to our economy, how a normal housing market should be contributing to our economy, that isn't really happening. And that's significant, especially as we get late into the economic cycle, especially as we think about sustaining our economic growth in the economy. The paper also, I just want to highlight a couple of the other macro benefits that we focus on. In particular, we think about the concept of a wealth effect, which is a very well demonstrated concept in economic literature, that as households become wealthier, their ability to spend on other products increases, and that they have a tendency to increase consumer spending. Now, of course, people accessing homeownership in a safe and sustainable, affordable way is critical, but over an extended period of time, the extent to which people can become homeowners and build wealth through the equity in their homes can really also represent a significant amount of additional economic activity for our economy. And then the last sort of macro benefit I want to focus on is the link between homeownership and small business growth and entrepreneurship. We heard in the last panel about how self-employed and small businesses may have challenges in getting the loans to become homeowners, but this is kind of thinking almost from the opposite perspective. And there's some research, a growing body of research that's drawing a link between homeownership and small business growth or entrepreneurship. And in general, that tends to happen because in many small businesses at some point will use their home as collateral to get a loan to invest in their business. Now, over an extended period of time, the extent to which we can increase home ownership should translate to a significant amount of additional ability for small businesses to grow and to invest in their businesses, creating jobs. And when we think about how important small businesses are for the size of our workforce in this country, that actually could be a significant impact, and we think it's a real interesting topic for further research that we hope will continue to establish that story. The paper also looks at a number of other benefits and kind of highlights many of the top reasons for benefits for homeownerships, for individuals, for households, for communities. And in particular, we focus a lot on the ways that homeowners are able to build wealth and gain financial security through the accumulated savings in their equity, through appreciation in their home, and then of course through the stability that you get from having sort of well-known, predictable monthly housing expenses. So we look at a variety of different factors, but having looked at all of these and really established both the macroeconomic and the individual household benefits of homeownership, we also wanted to look at what we're actually doing to incentivize homeownership in our federal tax system. And in particular, we wanted to look at what the impact was from the Tax Cuts and Jobs Act that was passed in 2017 and went into effect in 2018. Now, I know this group is obviously very well aware of a lot of the changes, particularly the reduction in the maximum indebtedness on mortgage interest deduction, MID, as well as the cap on state and local income tax deductions, which include real estate taxes at $10,000. Importantly, being the same cap for both single and married filers. So those are sort of direct changes that influence the way we're incentivizing homeownership. But also important, perhaps even more important when we start thinking about middle income households and households that are potentially future homeowners, the shift in the standard deduction, the dramatic increase in the standard deduction, was in effect an indirect policy shift in terms of how we're incentivizing homeownership relative to rentership in this country. And that's one of the things I really want to kind of focus on for the remainder of my time here. And in effect, if you're no longer itemizing your deductions relative to renting, there's not an actual incentive in your annual federal income tax. So for the group of people that are no longer able to itemize or no longer makes sense to itemize, in effect, they're not getting any federal tax incentive for owning a home, at least not in their annual income tax. And the truth is that group, when we look at the underlying data of what the IRS provides, that's a very large group of people that are no longer getting that potential benefit. So, the next couple slides look at those IRS statistics. This is in 2017, pre-tax reform. There were 42 million tax filers in this country that were itemizing. And when we fast forward to 2018, after the tax reform went into effect, that number drops by 27.5 million. So there are 27.5 million tax filers who no longer itemized in 2018. And, of course, there's a variety of financial situations that individual tax filers have, but the truth of the matter is the single largest sources of deductions that people would be itemizing for are state and local taxes, real estate taxes, and mortgage interest deduction. So we had this huge drop, and what's kind of even more surprising, perhaps you would say, or perhaps even concerning, is that when you look at who those households were that composed the drop, 2/3 of the drop in those who are itemizing fall in incomes between 50 and 200,000. Broadly defined, we've kind of referred to that group throughout our report as middle income tax filers. And, when you really account for the different costs and different incomes around the country, that group really is representing somewhere in the 40 to 80, 85th percentile. So it really is a good measure of what a middle income would look like. But that middle income households were representing 2/3 of the drop, and the drop happened across all the categories: state and local, real estate taxes, and MID. So what's the takeaway from the tax impact is that both through direct and indirect changes, the net effect in the tax data that the IRS reported was that there were many, many fewer tax filers who were itemizing, and that there was a disproportionate impact in terms of how many fewer middle income households were able to itemize and able to get, in effect, a federal tax incentive for owning versus renting. And when you dig even one level deeper into who the middle income households are, now I'm looking at household data from the census, which is a little bit different in terms of how they define income than IRS. But in effect, it is minority households and it is millennial households, the two groups of biggest groups of potential homeowners, who are the ones that no longer were able to itemize and no longer were able to get the incentive for owning versus renting. And that's particularly concerning when we think about the fact that those are the groups that had the biggest drop in home ownership coming out of the crisis. They're the groups that face many of the biggest hurdles to accessing home ownership, accessing credit. We've heard about that in the prior panels. Those are the groups that also represent the fastest growing groups of households and the biggest groups of potential homeowners in this country. And yet those are the ones that are sort of least able to get the benefit of a federal tax incentive following the rule changes. So what are the takeaways here in terms of what we've established and what we've looked at? First of all, when we think about the benefits for homeownership, they're large. They're large for individual households in terms of their ability to build wealth, especially if they can buy homes in an affordable way with sustainable lending products. The benefits for communities are significant. The benefits for the economy as a whole in terms of our overall economic activity and achieving the potential growth that we really should have relative to our history of how the U.S. economy has grown, those benefits are all very significant. When we look at the Tax Cuts and Jobs Act of 2017, now, of course, we could think about the broader impact of that tax cuts in terms of how they also changed marginal tax rates, how it changed corporate tax rates, what that meant for the economy at large, and whether or not that can contribute to home ownership in other ways, I think is a really interesting question and an important area for further research. But when we look at the direct tax incentives and the indirect incentive that comes because of the change in the standard deduction, what we end up seeing is that really the net effect was a dramatic reduction in tax incentives for middle-class homeowners, as well as for potential homeowners in the key groups of households that I think we should be most worried about when we're thinking about the potential for increasing homeownership as a country. So ultimately, when we think about the federal tax system and the way it's incentivizing homeownership, something that the federal tax system has really always done since it was first implemented more than 100 years ago, the federal income tax, this shift really ended up being, intentional or unintentional, really as a net effect, ended up being a dramatic reduction in tax incentives, and particularly for the groups of households that we should be most concerned of. Lastly, what we kind of start to get into in the report, which I think everyone will be able to see on NAR's website, is how to think about what new incentives might look like for home ownership, how to think about what might be layered into the federal tax system going forward if we were to think about equitably establishing kind of a clear and equitable incentive for homeownership that really could be accessed for broadly for the groups of households that need it most. And when we think about that, the potential benefits both for individual households as they could accrue wealth and benefit from financial security, for communities and ultimately for the economy at large are really very significant. Thank you very much. Next up is going to be Lawrence.
Thank you, David, for doing such a thorough research showing the benefits of home ownership, the economic benefits, the individual family financial benefit. Earlier in the morning, we heard of the social benefit, the children of the homeowners doing better attainment in schools, future income potential. So there are quite a large number of benefits associated with homeownership. I am the last speaker, and we started from the morning here in the National Press Club, and you lasted this long. Well, there will be a reward at the end, 4 o'clock, a reception. At the First Amendment Lounge, very appropriately named lounge here in the National Press Club. NAR, Realtors, we are a strong believer in the First Amendment because free speech, we engage in first in terms of discussing what should be the right policy in the benefit of the members, community, homeowners. And from that policy, we will have our free speech with members of Congress to see if we can move the dial. Also, part of the free speech is assuring that the political candidate who are supportive of real estate get the contribution from the Realtor audience. Thank you for many outside organizations who participated today in this very important topic. And also on behalf of NAR President Vince Malta, thank you to outside organization speaker who acknowledged that one cannot move any housing policy without NAR. So we have many people here in the audience. I see realtors from Illinois, New Jersey, Rhode Island, Tennessee, all across the country here trying to represent their community to assure that we have the right appropriate policy to advance what is good for housing. So let's look at another aspect of the housing benefit on top of what David Banks has already discussed. First, the challenges. We know that home prices have risen. The top line shows the home price appreciation. You see that little hump. The first hump was, in hindsight, something unsustainable, something that we do not want to experience again due to loose mortgage lending. That brought up the home prices to be too high, then it collapsed. Current home price increases are not due to easy lending. It is due to the lack of supply. In fact, lending condition, as prior speakers have mentioned, believe that it is too tight. There are many qualified people who would be able to get a very successful home ownership, yet the mortgages are not available. So current home price increases are completely different from what happened 10 years ago. Loose lending 10 years ago, today lack of supply. What is the bottom line? That is the family income situation. Steady increase, about 3% growth each year, but one can see how the income growth compared to home price growth, and one sees a tremendous large gap that is occurring. Put it differently, price to income ratio looks like this. So during the subprime lending days, due to easy lending, prices being run up, we had a high price to income ratio, unsustainable, it went down. Currently, it looks something similar in terms of price-income ratio, except the fact now the prices are due to the lack of supply situation. So from this chart, it looks like it's very difficult to buy home because homes have become unaffordable. But if one looks at the housing affordability index, what one finds is that the red line is the average. Today, we are still a little bit above average in terms of housing affordability index. This index is comprised of essentially three variables: home prices, income, and a third variable, mortgage rate. Because most people who buy home, they take out a mortgage, and if the rates are low, then it makes homes much more affordable. So even though we have seen some decline in affordability in recent years, we are still above normal historically. But and thanks to this exceptionally generational low mortgage rates. But one should not anticipate that we will face this low mortgage rate for the long haul. Maybe it will be with us in 2020, maybe for 2021, or even a couple of years after that. But at some point, it's going to revert back to normal. What that normal is, whether 5%, 6% mortgage rate, then it's going to greatly hamper affordability unless home price growth becomes much more manageable. That's why it's critical to have housing supply, which cannot be boosted in a single day or in a single week. It's going to take time to boost housing supply, whether it is through Opportunity Zone, where our commercial members get very active in building more supply, or through the home builder incentives. So we need to assure that more supply comes onto the line in the future, because this low mortgage rates, which have temporarily helped on the affordability, we should not expect that to be the case over the long term. Okay, so anyway, this is the affordability index, just rolling 12-month average in recent years to show that decline in the affordability because home prices have outpaced income. So even with this historically low mortgage rates, affordability condition is slightly being diminished, and one wonders what would happen in the long haul. Now going to the next chart. This is the actual home sales. So the other night, President Trump touted the State of the Union. There are many admirable economic figures. One can list off all the positive numbers related to the economic indicators. One aspect that President did not discuss so much, or in fact, I do not believe that he mentioned, was related to the housing market. Because home sales, even though jobs are rising, home sales are not breaking out higher. So we have a record wealth situation, a record low unemployment rate, job creation, yet home sales appears to be stuck. And part of the reason is the lack of inventory. Many realtors across the country have indicated they have a buyer, but just not at a home, multiple bidding process, one person win, 4 people lose out on the multiple bidding process. So we need to assure that there is an adequate incentive to bring about more supply to the market. Home ownership rate, also very similarly, like home sales, are not greatly increasing. At least it passed the low point, cyclical low point, but the growth in home ownership nationwide has been very sluggish. And as many prior speakers have mentioned, some groups are being left out, even in this slow increase in home ownership rate. So the home sales being stuck, home ownership rate not rising much, and it has an implication for the country. So this is the actual number of homeowners, not the home ownership rate. Every year, U.S. population rises, thankfully. So it rises, so naturally one would see that some people will become homeowners. So you see the line, essentially straight upward line. Then from about 2007, home ownership number has been essentially moving sideways. So is this an indication in a rising population that we will no longer think about home ownership as part of the American dream? Or do people still view as part of their American dream of financial wealth accumulation in the future? But currently, either due to the lack of inventory, maybe lack of the credit condition, the home ownership rate, the overall home number of homeowners are essentially moving sideways. If this was to continue over the long run, then one has to question, is America slowly shifting over to a renter nation? People from California constantly mention. California state is almost turning into a renter state, where it used to be majority homeowners, but now is almost close to being majority renters. So whether or not from country perspective, whether we want to welcome this trend or something to assure that this trend revert back to the long term where number of homeowners begin to rise. Another significant impact. If the homeowner population is not rising, and we have this data from the Federal Reserve about the net worth of a household, renter net worth, you have to squint your eyes to see what that is. For homeowners, it is substantially larger. We estimate that it is about 250,000 plus. Federal Reserve data is not yet currently available for 2019. I think it may be available next year with updated data. But based on the price growth trend that we have witnessed, that is a reasonable conservative estimate. So if this is the gap in wealth between homeowners and renters, and we have the case that number of people just simply cannot become homeowners, whether due to lack of inventory, lack of credit, or even lack of tax incentives. As David Banks pointed out, that without the tax incentive, people are responding to it. At my home, my wife puts the thermostat never higher than 68. She said, if you put it higher than 68, we pay higher utility bill. So there's a financial incentive to adjust. Academic studies show you raise a tax on cigarettes. Smoking among the younger generation greatly declined. People respond to financial incentives. So if there is no tax benefit for home ownership, we will have fewer homeowners. So in terms of thinking about tax benefits, we have to see. Some people mention down payment assistance or maybe refundable tax credit for buying a home. All that should be discussed, looked at carefully, and decided on. I think this is something that NAR members will be carefully reviewing, because without tax incentive, at least some number of people will not become homeowners without that incentive. And if that's the case, where home ownership rate is not rising, and we have this wealth difference, American wealth situation would be more divided between haves and have-nots. Next slide. Okay. And current wealth growth is very sustainable because this chart shows on the top line total real estate valuation in the country. Again, following the home price trend, the first hump, the bubble, then crash. Now the prices are in much solid ground because we don't have those loose lending. It's more of a supply constraint situation. But the bottom line is also interesting. Bottom line is the total mortgage outstanding. So what this shows is that this time around, when home prices are rising, homeowners are much more financially conservative. They are not viewing it as an ATM machine. They are not taking that extra vacation or buying the SUV. They're just saying this is an equity. Maybe I can use it in my retirement, or maybe I can pass it on to the next generation. So they can easily become homeowners. We are seeing in some of the recent home buyer trend where there is a greater number of gifting by family members to the next generation for the down payment. But that also raises the question, what about the minority community which do not have the access to high housing equity given the historical situation where they have not become homeowners? So given the current situation where you have this high net worth gap between renters and homeowners, and if there's no incentive to become homeowners, we may have this persistent widening wealth gap between the haves and have-nots. Next slide. And housing shortage, why do we have such an inventory shortage? The builders have not built enough, something that has been relayed many times today. But just graphically and numerically, this is what the numbers look like. It was mentioned that 1.5 million is the historical average. So during the bubble years, there was a little overproduction, then a strong collapse. So first few years of the collapse, one may say compensated for overproduction, but to be persistently under normal for past 11 years is leading to this housing inventory shortage. So whether removing regulatory barriers, or at least reviewing the regulatory barriers, or maybe the opportunity zones providing the tax incentive to build more, we need to figure out how to bring more supply to the market. Maybe we need to train more people to become construction workers, go into vocational training. So all that needs to be considered because we are in a drastic housing shortage situation, making it more difficult for people to become homeowners. Let me go back to the prior slide. Okay. So here is an interesting comparison. From year 2000 to recently completed year 2019. I use 2000 as a reference year to compare, not because it's the turn of the century, but if you open the newspaper back in the year 2000, this was, I guess, a little bit before the actual widespread of internet usage, so people actually got that hard paper. Flip to the newspapers. The stories about real estate was quite boring. There was not a talk about bubble, foreclosures, or housing shortage. It was a very boring news, something like 2% increase in sales, 2% increase in prices. So if that was the news in the year 2000, you may say year 2000 was quite normal. So using that as a normal condition, let's compare with year 2019. Top line, housing affordability is actually better now than back then. Home prices are much higher, but incomes are also higher. But the low mortgage rate is the big thing that is helping on the affordability. The second line, much lower mortgage rates. Population, we have 50 million more people living in the country. What about adult population, 16 and over? We have 45 million additional people in the country. Total households, families, 20 million more. Total jobs, 20 million more. Last line, what about home sales? So if we have better affordability condition because of low mortgage rates, more people with jobs, what about home sales? It's actually lower in 2019 compared to year 2000, implying that there are sizable pent-up potential people who could become homeowners if the situation was right. Again, credit access, housing supply, it would be good for the economy. David Bank showed that number. If we had more home building, home sales activity, great for economy, and the tax revenue that will go to the counties, just an amazing amount of tax revenue that will go to the counties in terms. But we are missing out on that because of a lot of friction that is occurring in the current housing market. So going to prior chart. So this is a spaghetti chart. So I just randomly chose few markets. Des Moines, I guess that was in the news recently. Kansas City, also in the news. But a lot of other cities, and I could have embedded many other cities into this chart, but it's to illustrate all real estate is local. Some real estate go up, some real estate go down, they recover. Other real estate market goes flatline. So what we decided to do is the following. To say that, okay, let's say a person purchased a property, independent of wherever they want to purchase, Des Moines, Kansas City, Dallas, Miami, it doesn't matter. You just randomly choose which market you want to purchase. And it doesn't matter whether you purchased it in 1998 or 2005 at the top of the bubble. Let's wait 7 years and see what happens. So in all these metro markets, if one held for 7 years, they generally average about 29% in price appreciation, translating into $38,000 in equity gain. Buy a home, build wealth. Hold it for 8 years, little more. 9 years more, 10 years more. 11 years undoubtedly will be higher, but we have to stop at some point. So we put it at 7 to 10 years. So one see that generally on average, it grows more. So this is my last slide. So some markets like Youngstown, Ohio, where they are depleting population, factories are shutting down, people are leaving Youngstown to go to maybe nearby Columbus or elsewhere, home prices have not recovered. They are seeing depreciation in home values. But we looked at every metro market, holding period of 7 to 10 years, and we find that 87% of the time they come out positive. So in other words, independent of the housing market price condition, generally speaking, you purchase a home, hold it for 7 years, 8 years, 9 years, 10 years, you are highly likely, 87% of the time, that you will be positive. Longer holding period, more gains. I only included price change, but we know that every mortgage payment includes principals. So if we included principals, you will be even higher than 80% in terms of equity gains. So the benefit of home ownership goes into multiple directions. It helps the economy. It has many social benefits attached to it. And I think that as an immigrant, when I first came to the country, my father said, well, we need to buy 2 things right away. I mean, there were, I would say, in today's relative terms, below middle income level. But they said, we need to buy a piano. I don't know why. And we need to buy a home. Because owning a real estate means being part of the country, being part of the country, participating in the wealth gain that comes along with it. And all the research data clearly shows that. So thank you very much. And just in case you want to know, I never played the piano. Thank you very much.
All right, thank you, David and Lawrence. Those were thought-provoking presentations, of course. You can find the new research report presented by David Bank on NAR's Policy Forum website under the Policy Forum event page on nar.realtor. You can also find links to the reports that were handed out at today's forum on accessory dwelling units and zoning. Thank you for attending today's Policy Forum. I hope you all found the keynotes and panels as informative as they were intended to be. You will receive an evaluation in your email about the sessions. Please take some time to let us know what you found most valuable. I hope that you can all join us at the networking reception right next door at the Holman Lounge, and hope to see you next year at our 3rd annual Policy Forum. Thank you for your participation.